Welcome to the Money to the Masses podcast, putting you in control of your finances. One mic, two idiots, and, according to our latest figures, 3 listeners. Here are your hosts, Damien Fay and Andy Leaks.
Before we start, Andy, I just wanted to say a quick thank you to our podcast sponsors, MoneyFarm. Now, MoneyFarm are the largest digital wealth manager in Europe, and they create portfolios of ETFs for their clients. They're incredibly cheap and ideal for somebody who's wanting to get into investing, and perhaps for more experienced investors who don't actually want to run their own money anymore. Now, they will even offer to run the first £20,000 of any of our listeners' portfolio absolutely free if they enter the code MTTM20K into the website at moneyfarm.com. For more information, check out their website. But for now, Andy, let's get back on with the show.
Hello and welcome to episode 141 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leaks. Damien, welcome back. How are you doing?
I'm good, Andy. We're back again on a late Friday night, aren't we? It's been another busy week, and I swore this week I would be. It's not to you, is it, Andy? It's me who makes us late. I would do it a bit earlier in the week, but yet again on a Friday night, we're recording the podcast due to me working like a dog.
So it sounds like you've been super busy as always then, Damien. What have you been up to this week? What's delayed you?
Well, do you know what it is, Andy? I'm one of life's...
procrastinators?
I am a bit of a procrastinator, actually. I'm funny, I'm one of these people who I'm quite extreme. I can be incredibly decisive, but I can also... do you know what it is? I think I get distracted. I'm distracted easily, I admit that. In terms of decisive, I'm the guy who, if you go to dinner with me, if I get down to like the second thing on the menu and I like it, I don't go any further. I can actually go to those extremes. There could be something amazing on the rest of it, and my wife's the complete opposite. But I do get distracted by the things that are of interest, like I did. Like I did. Like I did just got distracted. I was looking at something. Sorry, look. I just proved my point. What I was going to say is that we're doing video on Money to the Masses, and I this week shot a video on Facebook actually, and we'll put it on YouTube as well. So if you get the weekly newsletter this week, you'll see it. But go onto Facebook and go to our Money to the Masses page, and you'll see it. And I did a video that was about interest rates and about why they matter to you, and because this week we had something called Super Thursday with the Bank of England, and it was just a quick video, because video only works if it's relatively quick, because apparently our attention spans on video are less than 2 minutes and you lose most people. So I try and keep it short and sweet, but with an explanation, trying to teach people something and delivering an impact and a kind of action very quickly. So that was exciting, something different, and it actually worked really well. And I looked earlier, and it's already had 7,000 views, which is pretty good for a video that's about money. Let's be honest, this isn't any of the sort of football clips you see out there that get 4 million views. I'm talking about real life stuff, and people like it because of the analogies that I use. So go and have a look at it, because it's something that I'm doing that's different. But I'd also like people to throw out some topics to me on the comments, or email me just things you'd like explained very quickly. And there were some quite neat 1 or 2 questions came out of the comments below the video, which I might do as subsequent videos, but we'll see. So that was quite good. And also 80/20 Investor was 3 this week. It's the 3rd anniversary of 80/20 Investor as a product, which is quite a big thing in the world of finance, because when it comes to investing, it's almost what happens if your financial advisor was to make a recommendation. They have this kind of unwritten rule that they don't consider anything that is less than 3 years old, and that's partly because the rating agencies for funds and things don't consider anything, or won't give a rating to anything with less than a 3-year track record. So while I don't care about such things, it is one of those kind of milestones in terms of having a track record to show what you do is actually good and working and outperforming. So that's been really good. And over the 2 and a bit years I've been doing my 50k portfolio, I'm up 23%, so outperforming the market, fund managers and passive. So it's that was really good. So it's a bit distracting looking at that kind of thing, what we're gonna do about it. So I'm going to mention a piece actually about 80/20 Investor, but before we get onto that sort of stuff, Andy, how was your week?
My week's been all right, yeah. I mean, very busy at work, but it's kind of what you expect. Our work's end of sort of financial year is the end of August, so it's all hands to the pump. But it's a challenge. It's enjoyable.
You're lucky you don't do the payroll for some of these sports stars, Andy, because obviously this week Neymar went to Paris Saint-Germain for a ridiculous sum of money, which I cannot even comprehend. I did toy with doing a piece around that, but I didn't want to date the podcast too much. But Neymar, I'll just ask you this, Andy, see if you know. Neymar wasn't, or isn't even, he certainly wasn't in the last 12 months, the highest paid sports star in the world. Who do you think that was?
Highest paid sports star.
This is all sports, and it's actually measured in dollars. But that doesn't mean anything. But the figures I saw.
Yeah. Basketball, baseball. I'm thinking maybe Formula One. Maybe Lewis Hamilton.
I tell you what, Andy, he's one of the higher paid people, but I think he's only just inside the top 10. Ronaldo is the most. And Ronaldo, can you believe it or not, earned just short of $100 million in the last 12 months. 100 million. But he's quite a long way ahead of the like Neymar. I mean, this sounds ridiculous to say he's a long way ahead, but I mean, Neymar earned in the last year, I think it was something in the region of about nearly $30 million. So he was quite a way. Ronaldo's miles ahead, and it's a lot of its endorsements. But you were right, there's a basketball player who I can't remember the name of, was second. Third was Messi, and interestingly, fourth was a tennis player. So tennis players the men's tennis players, I should add, were quite well paid. Who do you think that was?
Possibly Murray, because he's had quite a good year.
No.
Or maybe Djokovic.
No, think of endorsements, because this includes everything. So who's somebody you...
Oh, okay, Federer?
Yes, Andy, see, there you go. But going down the list, there were quite a few not cricketers, they didn't pay that much. Golfers, which is clearly a well-paid profession. Formula One drivers, like you said, Lewis Hamilton was in there. And interestingly, one of the top ones was still, I mean, he had about $30 million, I think it was, in endorsements, was Tiger Woods. And Tiger Woods, exactly. And Tiger Woods has just dropped out of the top 1,000 golfers in the whole of the world. So that is incredible that he still gets that, especially given some of the behaviour he's done of late. So just looking at that, and the top 100 people earning sports stars earn over $1 billion between them, which just shows you the skew and inequality in this world. And actually Ronaldo earns about a tenth of that. So yeah, anyway, I've just kind of completely gone off at a tangent and done a mini piece that I didn't even plan to, but there you go. That just shows you the level of ludicrous spending that's engulfed the world of football.
Well, why don't we tie that in nicely? Let's say our listeners are lucky enough to be a sports star earning hundreds of millions of pounds, and they wanted to do some investing. Should we do some investing, chat? Should we go 80-20 first?
Well, we will go 80-20 actually, because I've just put the finishing touches to a research article for people for 80-20 investor members, which obviously is exclusive to them because they obviously pay for access. Now, if you don't know what 80-20 investor is, it's my DIY investment service where I give people research. I actually crunch the numbers myself and data-driven fund shortlist to help them invest. We've had some fantastic feedback, and you can look at that on the Become an 80-20 Investor page, which you can find via the front page of moneytothemasses.com. And on that Become an 80-20 page, there is an FAQ section and a review section where there are unedited reviews. So have a look at those. But what I wanted to talk about today was something again that would be evergreen, and we're currently at the stage in markets that we're at or near all-time highs. So the market has rallied a lot over the last 18 months, and generally speaking, since the world has been, the central banks have been printing money over the last 5 years or more, that the equity markets have generally gone upwards. Now, of course, people are getting nervous because everyone's expecting a big fall in equity markets, which we are overdue a correction in a way, because if you look at the last year, if you focus on US equities, they've gone one of the longest periods for most, I think it's decades, where they haven't had a 5% fall. So it's not technically a correction is 10%, but a 5% fall in markets. Now, if you go back over history, the odds are that we're going to get one in probably by the end of the year. That's just saying on historical standards, if this kind of anomaly we've had in the last year or so actually kind of reverts to norm. It reverts to mean that you do have a correction every now and then. So what people are doing is they're wondering what to do, and they're thinking, well, how do we invest for markets falling? And one of the things that's been printed a hell of a lot, it's like one of these conventional truths you hear, that people, conventional wisdoms, that's probably, I suppose, is a better way of saying it, where they say that in a market, like at the moment, the market's been moving sideways for a few months. We've gone up near highs, we've kind of buffeted around sideways. So we've not really gone up, we've not really gone down and broken through lows or anything. We've kind of just bumbled along. But what happens is the national press journalists and the active fund managers out there. Now, active funds are the ones that are run by managers as opposed to passives that we talk about, the ones that are just trackers. And there's a big active versus passive debate, which obviously, as you know, I couldn't care less about, because actually they work in different scenarios and you have to use both. Now, what's been, you'll start seeing is the FT ran a story actually. So it shows you that it's not just, it's quite highbrow stuff that people who print it, that in a market that's going sideways or possibly downwards, that you will be better off investing in an actively managed fund. So the stage is almost set for actively managed funds to finally outperform passives, which they haven't done for periods of time. And I decided I'm going to look at whether that's true or not. And I went back sort of 20 plus years and did a load of analysis looking at upward markets, downward markets and sideways ones to see, is there a trend for passives to outperform in certain conditions and actives to outperform or underperform, and whether that conventional wisdom is actually true or not. And I'm not going to tell you what the answer is, because obviously it's for 80-20 investors. So before you sort of go, oh, I'm going to tell you something else though that came off of that is particularly interesting for people. Now, one of the things that came to light is that obviously active managers as a group, we're not talking about individuals, have had periods where they do outperform. And when you look at that, they suggest that that's because they are very clever stock pickers. So you means that you can find some kind of outperformance, find shares that are going to go up even in sort of downward markets or sideways ones, or ones that are going up, you can find real gems. And that's the argument, that computers don't do that generally, they just track. But fund managers are a clever bunch, and they can use their wisdom to find these things. Now, ignoring sort of individuals, if you took them as a group and say, well, if that's true, then surely their outperformance is down to that ability to find those absolute gems. Now, one of the things that came out of the research is I looked at periods over the last decade in particular where active fund managers had outperformed. And on the face of it, it seems to be that they are able to, as a group, pick stocks and outperform passives. But it's like all these things. It's really a bit of a lesson in how you do analysis. You look at it, you find seemingly something interesting, and you try and break it, and then you try and find other relationships. And what is interesting is that I don't believe that most of them do outperform because of stock picking. Because what happens is that if you look at the trend of when active fund managers in the UK equity space, so ones that invest in UK equities, they tend to outperform when smaller companies outperform. So there's this idea that there are large companies like the FTSE 100, and there are ones further down, so FTSE 250 and below. Now, there are periods over the last decade where investing in smaller companies have massively outperformed picking a massive company like the FTSE 100 tracker. So that trend is something that has been shown over time to be a reliable way to outperform. Now, this is something else that people learn or can take on board. They've been shown over 100 years. There's only three investment strategies that over 100 years of research, looking back and analysing markets, that have been shown to consistently, sort of reliably outperform. Say consistently, that sort of sounds like they do it all the time, but the strategies that have been shown to provide outperformance, and they are momentum, which is something that 80-20 investor is built around and forms part of that algorithm. There is value investing, where people do go and try and find stocks that are unloved for whatever reason, and then they're cheap, and then they buy them, and the market realises they're wonderful, and then it rockets up and you reap the benefits. Or smaller companies, so that's smaller companies investing. So you invest in a small company and it becomes a big company, becomes successful. And of course, you bought into it when it was smaller. Those value of those shares goes through the roof. Great examples. Imagine, not saying they were small, but we had Apple going through the roof in terms of stock value. There've been some fantastic numbers if you'd invested in Apple when it first launched in probably, God knows how much, $10,000, you'd be in a multi-millionaire because of the growth. So it's that smaller companies effect, and that exists. So those three methods. And so what actually happens is that these managers, it's coincidental, but it's more than coincidental. Their outperformance coincides with the smaller companies doing particularly well. So what I suggest it shows is that really fund managers start to gravitate towards smaller companies investing. Because if you are in the UK equity income space, you're investing in UK companies, you're going to start trying to do something different. So you're going to start going down and investing in smaller companies. But that general trend, rather than you being a wonderful stock picker, that trend of doing that has been shown to outperform generally over time anyway. So the sort of message to this part of the podcast is that active managers tend to outperform passives when smaller companies' shares do better. So when smaller company investing does well. And there are periods where that doesn't happen, that investing in, say, a FTSE 100 index tracker will outperform a FTSE 251 or lower. But at the moment, we seem to be entering a period where the smaller company stuff might be doing quite well again. But it all depends if the economy starts to pick up. And so we could get into a period of outperformance for them. But it's just an interesting thing again, because a lot of the stuff they write in the press isn't technically true. There's no real evidence to back it up. So there you go. There's a bit of an insight. Active managers will outperform at periods, passives will outperform for various periods, but probably the correlation of when the group of actives tend to outperform as a whole group, it's more down to actually the style of investing at smaller companies rather than them being active. Before we move on, Andy, I just wanted to quickly mention 80/20 Investor. Now, 80/20 Investor is my DIY investment service. Do go and check it out. I empower and teach people how to invest their own money. The service provides data-driven fund tables. The data is driven by my own unique 80/20 Investor algorithm, which I created. You also get stop-loss alerts, you get research articles and insights, you get market commentaries, monthly commentaries, and DIY investment lessons, but you also get access to my £50,000 portfolio, which is a portfolio of my own money, which I run live on the site for members to see, and it shows people how I use the service to maximise my returns. And in the first 2 years of doing so, I turned £50,000 into £59,500, which is a 19% return, beating investment managers, professional fund managers, financial advisors, investment banks, passive trackers and the market. So everybody can have a free 30-day trial of 80/20 Investor, and you can claim that by going to moneytothemasses.com and going and clicking on the 80/20 Investor hyperlink at the top of the page. So go and try the service. Let me know what you think of it, and I know from the feedback that you're going to love it. But for now, on with the show.
I learned a lot with you, Damien, on a Friday night.
Do you know what, Andy? I'm glad you do, because my brain's pretty wired on a Friday night. Do you know what? I want to drink coffee, but I know I'd be awake for the rest of the way through to Saturday. But the next piece, you'll like this, Andy. I was inspired by my lack of forward planning and work-life balance. And this week I was reading. I read a lot of stuff. I don't just read money stuff, but I'm a real fan of productivity. Okay, I'm a real fan of things that to do with work-life balance and trying to have a better life. And I came across an article about 10 ways to get a better work-life balance, which I thought would be particularly appropriate given my my ability to be working late on a Friday night and not seeing my children. But the other reason I done it is because there were some really good parallels between some of the messages to be able to have a better work-life balance. They can also be applied to being able to have a better relationship with money. So I'm going to go through this this article and some of the tips that they gave, but I'm going to also give it a spin and twist it onto money to show people how you can think a bit differently but actually improve your finances. So the first tip, who is the article actually? Where was it in? I think it was in the... It was written by somebody for The Guardian, I think. Because I like to name check people. But the first tip was step away from your email. One of the biggest things if work is encroaching in your life, in our world of being completely connected, that we're always getting emails pinging. And so you need to stop that. And one of the ways they tell you to do that is to turn off your emails. You literally, when you leave work, shut down. You don't have it on your mobile phone. You can. We talked about it once before, I think. I on my phone, turn off email notifications so I don't get them. I have to manually go and check. But one of the things that I do quite like with email productivity, there's some really good apps out there and that you can use to make emails less intrusive. One of them I use is called Spark. Now, I only mention it because I like it, and it's a really good way of being able to swipe emails into the inboxes and stuff. So when things come in, you don't have this. You're not working from an inbox. You can put it into quickly into folders, dismiss it, move it on till tomorrow, that kind of thing. So makes you less of a keep checking your inbox, if that makes sense, because it makes you a little bit more productive in the way you file things.
Okay.
But the analogy for money is that you should stay away from your email, because there's been shown that companies will email you at key times when they think you're going to spend money. So emails don't go out from companies at random times. They send it to you when they think you're going to spend money. And there has been evidence before to show that they will do it at in the early hours of the morning sometimes, because they know the people who are insomniacs or having trouble sleeping, probably like me, a little bit fuzzy-headed at the moment, you'll make decisions that are a little bit more impulsive. So keep away from your email, because obviously, like anything, you'll go on Amazon, you go and just dare to look at Andy Leaks's book about dieting and Minimise Me, and they'll be emailing you about every other book that Andy's written or somebody else has written to try and make you buy those as well. So it's one of those things that email can be a nightmare, making you spend more money. Now, the next thing they say is just say no, which is very easy to say than do. But the premise of it is that your boss asks you to do things, you should just tell him to very politely do one. And I'm not quite sure that will work in every environment, but it's the same thing with money, the parallel, that it's cold callers, you should say no. If somebody approaches you with something that they want to sell to you, if you haven't actually gone out to try and seek that, then you probably don't need it. So it's just say no. So all the cold calling bans in the world can come in, but they still won't stop people who are scammers or fraudsters to try and ring people up or doorstop selling. You just need to tell them no and get lost. The work smarter, work not harder. Now that kind of links into the productivity thing I was saying about you're trying to work a little bit more smarter rather than putting in extra hours. Now there's some quite clever ways I've seen to do this, not mentioned in this article, but there is a book that I started to read. I think it's called The Productivity Ninja. It's quite a good book actually. They have some quite nice tips in terms of applying your concentration in a day to the right task. So for example, we only have a couple of hours a day where we're at our absolute peak. And
can you tell me what those 2 hours are?
Well, do you know what? Everybody's different, and this was quite interesting. Mine are typically between 10 and between 11 and 1. That's when I'm at my peak, and I have another peak, actually probably between 5 and 6, which is a rubbish time to have a peak, because obviously you're trying to get home and see the kids or whatever it is, and also if you're at work, that's rubbish. But everyone has their different natural rhythms, and before and after lunch you have dips as well. So, but there are kind of 3 levels where you're really on it. Your A game, your kind of B game, and the C game when you really just need to file your paper clips and stuff like that. So you can apply your tasks to key when you're really feeling it. There's no point when you're in your A game filing your paper clips. So it's quite a nice idea. And the whole idea of working smarter and not harder can apply to money. And I mean, I'm a big fan of the 80-20 principle generally, and hence why 80-20 Investor. It's not just a plug for 80-20 Investor, but it's about having a process which helps you cut through all the noise. And if the media, the sort of craziness that goes on, we get overloaded with data, and I think sometimes that can cause us inability to choose, and therefore inertia. It's actually got a name, hasn't it? Isn't it the paradox of choice or something like that, which is where you get too much choice, you don't do anything. Going through the others is leave work at work, which is shut your phone down or leave your computer behind. I suppose you could have the equivalent. Some people would say leave your card at home if you're going to go spending. That doesn't quite work these days, although there are some benefits of having 0 spend days, where you don't try not spend any money in a day as a challenge, and then challenge is to have more of those days in the month. And there are people that do them quite successfully. I struggle, but forget about perfection. That's another one for your work-life balance. If you're always trying to aim for perfection, and you can never let things go at night when you're in bed and you're still worrying about work. And money is very, very similar, because everybody thinks about switching energy or car insurance and all these things. They're always trying to get to the optimum, as if there's an optimum plan in life or an optimum strategy or an optimum product. It just isn't the case. So you need to let go of that idea that that there is some sort of perfection that you're not achieving, because then you just feel like a failure. The fact is, most of your results will come from 20% of your efforts, the 80-20 principle. So you don't need to keep doing the same thing. You don't have to keep reviewing your energy bill every 2 minutes and things like that. So don't worry about perfection. Don't worry about everybody else. It's okay to make mistakes. One of the last ones are ease off the adrenaline. I suppose that's the idea that some people like to work to deadlines and will push themselves and work. I mean, I think I can have a similar thing with money about adrenaline. People like the adrenaline of spending and buying things, and so therefore it's the buzz, and you've got to wean yourself off that. And the way you do that with money is have that pause where you go to buy something and you think, do you know what, that 2-day rule, where you sit there and go, do you know what, if in 2 days' time I'm still really wanting this, then that is a great idea, I'll go and buy it. But if in 2 days' time, when you've had time to think and step back, and you think, now, do you know what, I don't really need that, then yeah, that was a wise decision to actually not bother. So that eases you off that adrenaline junkie when it comes to money. And their final point is to think about retirement, which obviously has a complete overlap with running money anyway. And their view is that you need to think about your retirement. I don't think they mean dreaming, sitting at your desk with your feet up dreaming about retiring, but I think they mean that you need to plan about what you are going to do. So you need to have hobbies, you need to have interests that are outside of work, and because when you retire or you go part-time, you're going to need these things, or you're going to want these things. And actually it's good to, you don't want to get to the point where you retire and suddenly think, now what? And work has been your entire life. So if you start thinking like that early doors, then you're going to be much less work focused. And of course, with money, thinking about retirement is never a bad thing. But I've got a real thing about the idea that retirement equates to pensions. Now, I don't believe it does. It certainly doesn't have to. Pensions are a product, and financial products are good and they can help people, but they are not always the solution. I'm a bigger fan of trying to have alternative ways. I mean, there's nothing wrong with trying to start a business, or invest, or if people want to do property and things like that, but there are other means of funding retirement. If you have a lifestyle that produces an income, say you become a blogger, I mean, go and listen to the One Giant Leap podcast to hear some inspiring stories of people who've done things, and see our Facebook group that's growing all the time of people who are starting new projects on that group as a result of what we're trying to help them with, and other people talking to each other and sharing ideas, and they will start building a second passive income. So go on Facebook and look for the One Giant Leap podcast group. You can find it via onegiantleappodcast.com actually, if you go that way. But yeah, there are other ways that you can fund retirement. And actually, what would be wonderful is if you all built a life which you aren't trying to take a holiday from or retire from, because it is a life that you actually wanted. So you're doing things you enjoy and you're getting paid for it. So there you go. So that's the end of that piece, Andy.
So you mentioned earlier we're going to talk about energy. We're going to finish off with that piece. What are you going on about?
Well, do you know what, Andy? I'm not going to dwell on it, because the podcast is already getting to that magic 30-minute mark. We like to keep it around. Obviously, in the news, there's been a whole load of... Well, it was British Gas was the spark, really. They decided to ramp...
British Gas was the spark.
Do you know what? I didn't even mean it. I'm too tired to laugh at my own jokes like I normally do. British Gas have decided to ramp up their prices, and obviously the media have gone into meltdown about it. Quite rightly, there is an element of, it feels like they're profiteering, as are most other energy companies, because what we end up having is some weird cartel now, where companies can seem to just profiteer off of ordinary people. Now, one of the things that I'm only going to mention it very quickly because we've talked about it before, but the key is to switch. and to shop around. And interestingly, the summer is a good time to do this because people typically fix their energy bills for winters, so that you'll get a deal and have one winter or 2 winters, and then you come off that deal and you default onto the standard rate of the provider that you're with. So come the summertime, when people aren't using gas and electricity, they tend to go onto that standard rate, and to be honest, they're not really thinking, and they've kind of forgotten about the whole thing and don't really care. And so it's a good time to then start shopping around, because before they start ramping up the bills ahead of the next winter that's coming, you can look around and get the best deals, because once they start pushing up prices, other people start looking around, and supply and demand always dictates that the best deals disappear once everybody starts shopping around. So do shop around. We've covered it in a previous podcast. If you go on to moneytothemasses.com, there is an article. If you put in the search bar, if you search for switch your energy bill or something similar, you'll find plenty of information, or use a comparison site that's out there. I mean, one of the things you have to be aware of is always watch for the fact that they will tend to promote the ones that they get paid more on, preferential rates with these comparison sites. So you need to have a full market search. I think one of the best ones, without doubt, is not plugging the guy, but Martin Lewis's Energy Saving Club is one that I do think is quite good, because they do continue to email you afterwards to say that you can get a better deal on this one. If you set a limit for when the best deals out there can save you another, say, £100 a year, then you get emailed again. Of course, they're making money by you switching. They get paid every time you switch different providers, but I think it's actually not a bad service. So do it. I hate doing energy bills. I did it, and it didn't take me very long. And if you don't believe me, you can go back to a podcast probably about 6 months ago where I talked about it.
Good stuff. Enjoyed that, Damien. Thanks very much. If you want to get in touch with Damien, you can, of course. As always, it's podcast@moneytothemasses.com. Or you can contact Damien on Twitter. He loves to hear from you on there. It's @moneytothemasses with the number 2. And you can get straight through. Oh, do review the podcast. It's really nice to get your reviews, and it helps us push up the charts. Damien, anything else?
No, and subscribe to the One Giant Leap podcast too, if you've not already done so and you've not heard it, because the next season will be coming hopefully by the autumn. I just need to get my act together.
Until next time.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.